Now we're going to learn about something called depreciation. But first we need to know what plant assets are. Plant assets are long-lived, tangible assets used in business operations. So you probably can understand the part about being used in business operations, but what about long-lived? Long-lived means something that's going to be used for a while, something that's going to be around for a while. For example, your staples for your staplers and your copy paper for your copy machine are not long-lived. Those will be used up relatively quickly. And tangible means something you can touch. So these are physical assets. Now, what is an asset that is not tangible? Well, that would be something like a copyright or a trademark. So we don't depreciate things like that. So we do depreciate plant assets, which are long-lived, tangible assets used in the business operation. So what are some examples? Land, buildings, equipment, and furniture. Also things like computers, which I guess would fall under equipment. And vehicles too. Vehicles are a common example of something that is depreciated. So these plant assets, except for land, are depreciated because they lose value or they wear out over time. For example, if you buy a truck to make deliveries for your delivery business and you pay $50,000 for the truck, 10 years from now, is that truck still going to be worth $50,000? No, because it's going to wear out over time. Eventually, it will be worth almost nothing. So in accounting, we use a process called depreciation. What is depreciation? Depreciation is the allocation of a plant asset's cost to expense over its useful life. So remember, when we first buy like a delivery truck, we record it as an asset. Why? Because assets are economic resources that have a future benefit. But eventually that truck will have no future benefit. So we have to gradually lower the value of the truck on our accounting records to show that it's slowly wearing out over time. And as these assets wear out, their future benefit slowly decreases, and depreciation tries to account for this lowering of value. Depreciation also attempts to match the expense, which is depreciation expense, with the revenue that the asset helped generate during the year. This is an example of the matching principle. What does that mean to you? It really means don't forget to record depreciation, the gradual wearing out of your plant assets, such as your buildings, your equipment, your vehicles, your furniture, your computers, etc. But how about land? Does land wear out? No, land does not wear out even though it's a plant asset. So land is not depreciated. So let's find out how we calculate depreciation. So there are several ways to calculate depreciation, but for this class we will only discuss one simple way to calculate depreciation. It's called straight line. It's the simplest and it's also the most common. In more advanced accounting classes, you'll learn about the other you'll learn about the other methods to calculate depreciation. So we're going to learn about this depreciation called straight line depreciation. Now look at the graph up above, and it's representing the depreciation expense for an asset. And it looks like it's $200 every year. So notice how if you drew a horizontal line connecting the top of each of the bars, it's just a straight line. That's why they call it straight line depreciation, because it turns out to be the same amount every year, no matter how much you use the asset. So let's look at the formula. So the annual depreciation for an asset is calculated by taking the asset's cost minus something called residual value, and you just divide it over the years that you think you'll be able to use that asset. So what is residual value? Residual value is an estimate of the worth of the asset at the end of the useful life. So let's say you buy a truck for your delivery business. If the truck costs $50,000 and you think when you're done using it, you'll be able to sell it for 1,000. Then the top of the formula would be 50,000 minus 1,000. And if you thought you could use the truck for 7 years, 7 would be on the bottom. So then you take 49,000 divided by 7, and you would get $7,000 of depreciation expense per year. Now, in some accounting books, especially the older ones, residual value is also called salvage value. So like you're going to toss the truck, you're going to get rid of it, but it has some salvage value. So if you hear me in a video accidentally calling residual value salvage value, just know that they're the same things. Now in my accounting lab, a lot of the problems and exercises, the depreciation amount is calculated for you. So you won't have to use this formula a lot of times. But on the project, you will definitely have to use this depreciation formula. So don't forget to come back here and review this video when it comes time to record depreciation in our project. And again, this method called straight line depreciation, it's called straight line because it results in an annual depreciation amount that is the same amount every year. Just like the top of the PowerPoint slide, it shows that there's $200 of depreciation per year. It's the same every year. So let's do another example. Let's say your business has a truck and it costs you $12,500. You estimate it will last 10 years and be worth $500 at the end of those 10 years. Calculate depreciation using the straight line depreciation formula, which is asset cost minus residual value divided by estimated years of usefulness. So let's plug in the numbers. So the top part is asset cost minus residual value. The asset cost is $12,500. The residual value is 500. So the top part of the formula is 12,500 minus 500. And then the bottom part of the formula is the number of years we think we'll be able to use it, 10 years. So you do the math, and annual depreciation is $1,200 per year. And that's a depreciation expense. So this is an expense that the company gets to use to offset their income, so it lowers their taxes. And so the straight line graph is in the top part of the PowerPoint slide. Notice for this asset, it turns out to be $1,200 per year, and it gives us a nice straight line of depreciation that's the same amount every year. Now, what if the company chose to record depreciation monthly instead of annually? What amount would you use for the monthly adjusting entry for depreciation? Well, you just take the annual amount, $1,200, divided by 12 months, gives you $100 of depreciation per month. So now that we recorded this depreciation, how would we record the adjusting entry at the end of the accounting period to record it? Here's how we are going to do it. Notice it's December 31st. It's the end of the year, so we need to record depreciation expense. So depreciation expense is going up. And how do expenses go up? With a debit. And now notice they have depreciation expense, comma, truck. So what they're going to do is they're going to have depreciation expenses probably for different types of assets. And what was the annual depreciation? It was $1,200 from the previous slide. And now the credit is a new type of account. It's called accumulated depreciation on the truck, and it is a contra asset. We'll learn on the next slide what a contra asset account is, but just realize that at this point a lot of students think that instead of crediting accumulated depreciation, a lot of students think that we would lower the value of the truck directly with a credit. We can't do that because we always want to keep the historical cost of our truck, which in this case was $12,500, listed in the truck account, so we always know how much we paid for it. On the next slide, we'll look at some T accounts to help us understand what a contra asset is. So we've got three T accounts. On the left, we've got the truck account. Notice we have $12,500 on the left side showing the historical cost. Now we won't lower that value ever unless we got rid of the truck in the future. So that $12,500 will always be there to show us the historical cost of the truck, and we won't affect it. In the middle, we have the contra asset called accumulated depreciation for that truck. It's called a contra asset because it lowers the value of its partner asset. In this case, the partner asset is the truck account. And because it lowers the value, its plus is opposite the plus on the truck account. So the truck account has a plus on the debit side, so a contra asset account, like accumulated depreciation, always has its plus side on the opposite side of that asset. Contra means opposite. So that's one way to remember what a contra asset is. Its plus is on the opposite side of the asset, and it lowers the value of that asset. So contra assets always have a credit balance. Now later on in advanced classes, we will learn there are things like contra revenues and contra equity. So don't mistakenly think that all contra accounts are contra assets, but in this class, we're only going to be learning about contra asset accounts. So this contra asset account, the accumulated depreciation for the truck, will always be paired or partnered with the truck account. Because this accumulated depreciation is only for that truck, these two accounts will always be side by side forever until we get rid of the truck in the future. So that means on the chart of accounts, these two accounts are side by side. On the balance sheet, these two accounts are side by side. On a trial balance, these two accounts are side by side. So what is the purpose of the accumulated depreciation account for the truck? Well, it holds the sum or the total of all depreciation recorded on that truck, which is a plant asset. So the $1,200 in the accumulated depreciation account is basically trying to estimate how much has that truck worn out. So the value of the truck is the $12,500 minus the amount that is worn out. So minus the $1,200. That's called the book value. So book value, to calculate the book value, its cost, $12,500, minus the accumulated depreciation. So for our truck example, after 1 year depreciation, remember the depreciation is $1,200 per year. So the way we calculate the book value is we take the cost of the truck, $12,500, minus the accumulated depreciation, which is $1,200. So that gives us a book value after 1 year of $11,300. So why do they call it a book value? Well, remember when accounting first started, they did it on paper, and the papers were kept in books. So accounting was kept in books. So if you ever see book value, it just means the value in our accounting records. So now, here's a question for you. Since they call it accumulated depreciation, what way do you think accumulated depreciation will go? Up or down? Is the truck going to wear out more, or is it going to suddenly get better and wear out less? Well, the name of the account, accumulated, tells you that it's just going to go up and up and up. So the book value of the truck will change every year. So the book value will decline gradually as the truck gets used more and more and wears out more and more. So let's look at the book value of the truck after 2 years. So remember, book value is cost minus accumulated depreciation, and we're going to calculate the book value for a truck after 2 years. So the cost of the truck is still 12,500. That will never change. And how much will the accumulated depreciation be after 2 years? Remember, it was $1,200 per year. So after 2 years, it's going to be $2,400. So what's the book value of our truck after 2 years? It's 12,500 minus 2,400, which is $10,100. So gradually over time, our book value of our truck will approach zero, and it will eventually get to zero. So that's your introduction to depreciation. And don't forget, we've learned a new type of account called a contra asset. That just means it's opposite of the asset. That is its partner account. So because it's opposite, its plus sign will be on the opposite of the asset's plus sign. And now when I show our expanded accounting equation, sometimes I will show you this format showing you at the bottom that a contra asset has its plus sign on the credit side.